company. Thanks to Professor Sagwell and his team here that we have been also, reaping the benefits of, 2 years work which they do here, and we utilize those services in our industry. Subject is very, very topical, and I again congratulate the conference team to have this topic because this is the need of the hour now. Coming to India Vision 2020, you know it that we have undergone a severe downturn in the economy, and whatever we see today, it is the result of last 5 to 10 years of work, which we have unfortunately gone haywire. And in this scenario, the government has drawn a paper, Vision 2020, and they would like to see that India follows its path. And fortunately, despite all these problems, we are again, there are people from outside India, but I don't know how much they agree with us or not, but certainly we are one of the bright spots in the economy. We are one of the large economy which is still, despite all these problems, growing fastest in the world. And if you believe in BRIC report, let me tell you that we have the potential to become the third largest economy in the world, not in 2050, but very, very soon in the next decade itself, if we keep on growing at 9 to 10%, which Vision 2020 projects to do. We would like to, Vision 2020 envisages that we would like to grow our GDP to 9 to 10% very soon and attain a double-digit growth of 11, 12, 13% by 2020. And this we want to attain through a manufacturing growth of more than 10% per annum to be achieved by 2020 through Make in India initiative, which this government has launched very recently. We would like to generate more than 100 million additional jobs in the manufacturing sector by 2020. And this will come through increase in share of the manufacturing sector in GDP, which is at least now 16% to 25% if we have to achieve those kind of numbers. We would like to have physical infrastructure, develop further physical infrastructure through industrial corridors and smart cities. We would like to see that railways, the infrastructure developed through participation of private sector, both in managing railways as well as owning railway infrastructure now. The Vision 2020 also proposes that we will achieve energy security by reducing oil imports to the large extent possible. And also the capital formation, which has gone down now to around 26, 27, 8% to 30% of GDP by 2020. And if we have to do this, if we have to grow like this, certainly we need one thing, which is the input, which is the fund, capital. And capital is a must for all this. If we have to grow 9 to 10% of GDP, we require a lot of capital. And where is it going to come from? We know in India, we follow a very traditional path of funding, and we are, we call it two ways of raising funds, intermediation and disintermediation. And in India, intermediation is the way of raising funds. That's a unfortunate part, but it's a more simplistic and more easy part to handle. If we are to look at funding, we have to look at three things: whether access to funds is there, availability of funds is there, and what is the cost of funds. Coming to the access of funds, as I told you, there are two ways: intermediation, that is banking, and which is the main channel of raising funds now. The whole industry, retail, infrastructure raises money through banks. And especially for financial inclusion also, we need banks, because capital market will not attend to this, because they will certainly will not look at from the social perspective. Coming to the disintermediation part, which is a better way of raising funds, but not prevalent in India. If you look at any developed market, capital markets are the main source of raising funds. Even in China, where you think that that is also a bank loan market like India, still 25% of the GDP is through the corporate bond segment, and we are hardly 5 to 6%. That shows how primitive we are there still in the development of our capital markets. Capital market will provide access to both equity and debt, I think, and that's the way we need to work on further. Availability of credit has to be to all the sectors where it is required, and we require financial savings for this. And you know it, we are a saving nation, but our saving rate has been going down quite considerably. We were nearing around 40%. We have come down to around 30% now, and it happens through mobilization of deposits, insurance, provident funds, and equity markets. In capital market, we require a lot of investors in debt market, which is also a problem now. There are only institutional players who are in capital market. There are banks, there are insurance companies, but no retail investment in capital market, which is again a cause of concern for India. Third issue in funding is cost of credit. It has to be a reasonable cost, which people can really go and invest and make fair returns out of those funds. And I think we have to see to that the base rate, repo rate, and the transmission of those lowering or repo rates happens in banking sector fast. Structure of financial sector in India, I told you that there are mostly banks. Institutional setup, non-institutional setup. In institutional setups, we have banks, we have financial institutions, though this breed is little bit going down now. IDBI and ICICI, IFC were main development financial institutions, are now universal banks now. There are NBFCs and there are new institutions which Reserve Bank has recently given licenses, payment banks and small banks. Day before yesterday they have announced even 10 small banks, which will be the new institutional setup for the financial sector in India. In non-institutional setup capital market, we have equity side and debt side, and debt side we have corporate bonds and commercial papers. Now, looking at the outside, in addition to the internal sources of funding, there are external sources, and external sources mainly come from foreign direct investment as well as external commercial borrowings. In foreign direct investment, it in FY15 as a very, very pleasant year for FDI investment in India. They grew by 27% in FY15 itself, and it was because of the liberal FDI regime which this government has initiated. There are a lot of FDI limit raising in medical devices, construction, railways, defense and insurance. In fact, more needs to be done, though they have increased the limits from $15 billion to $20 billion now. But I think we need to raise FDI limits in other sectors like manufacturing infrastructure, because they require more capital, they require large dose of capital, and FDI could be one way where they can bring money. Second is external commercial borrowings. Company can access cheaper cost of funds outside India and raise money. The only problem here is you have to take currency risk, though you can pay in Indian rupees in India, but you have to cover currency risks if fluctuations, if any happens. And you can hedge those currency risks, but the hedging costs are very exorbitant as of now. They go as high as 7%, which make for those companies who don't have a natural hedge, becomes a real problem. Now, banking, which is the sole and very important source of capital for funding, there are a lot of challenges. And first and foremost, because if you have to grow, you need funds. And if you need funds, banks should have capital. And for banks, it, because of various problems banks have been facing for a few years. What has happened to the economy. There was a problem, and add to that the policy paralysis which this government got in when they came to power. Last UPA 2 regime has lost a lot of issues on land, environment, mining. All those issues resulted in several projects being stalled, and that has really affected the banking health. And the capital requirement of banks have increased manifold. If we look at the capital adequacy requirement which was proposed under Basel III regime, we need around this is a government figure, 1.8 lakh crore of money needed in next 4 years to put in public sector banks. And the government thinks that 70,000 crore can be brought from the budget during the next 4 years, and the balance of 110,000 crore, 1.1 lakh crore, has to be raised for the market or selling non-core assets. And to bring this capital, government think that they'll bring money, 70,000 crore itself, from the budget provision, 110,000 crore by other means. Government want to dilute its stake in public sector banks so that more private participation can happen in public sector banks. They are also thinking that we can consider some, various novel options of non-voting rights shares, differential voting rights shares, golden voting rights shares, as is happened in the UK. Issuance of Tier 1 additional bonds, because as of now, the valuation of the public sector banks is quite dismal. And let's start with Tier 1 bonds, and when valuations become good, they can be converted into equity at that point of time. Creation of holding company like an investment company of government, which proposal was even mooted in the last government time. I think this government, Department of Financial Services, is looking at this proposal once again. Merge multiple, after this government has come, Department of Financial Services have really done many things to see to it that, the PSUs, public sector banks, comes to the, normal level. Second, and a related aspect is NPAs, because if you have a bad environment, you have bad loans, and you have a lot of credit losses, which affect your asset quality issues. If you see our gross NPA level, it has gone up from 3.4% in FY13 to FY14 4.1% in FY14, and to further to 4.6 in FY15. If you look at total stress asset ratio, it's as high as 10.9%, which is a big issue. When our banks have capital adequacy around 10-11%, and if your stress assets are also around 10.9%, you are virtually talking of a position which is quite dismal. And we need to do something on this, and this is a result of economic problems and also the policy parameters which last regime has put this country in. And if you look at 5 sectors which contribute only, the total banking, 25% of the total bank credit in these 5 sectors, but unfortunately 51% of the NPAs are in these 5 sectors. So they are the problem areas for us. Mining, iron and steel, textiles, infrastructure and aviation are the 5 sectors which constitute only 25% of the total bank credit, but has 51% of the NPAs. So that shows that there are real problems, and government, which this government is working on, and Dr. Anand also hinted on that. I think we need to look at these 5 sectors so that we can really bring sanity in the banking asset quality very soon. Solutions are that we have to take recourse to ARCs, which have been formulated, but we don't have a very, very good experience in the ARCs. I think we need to do something to streamline working in the ARC so that ARC does the function which they are supposed to do. Recently the Reserve Bank has recently announced 5x25 scheme, because lot of long duration projects have loans which are 5 years, 7 years loans, whereas you can't repay those. Cash flows are not sufficient to repay those, loans in 5 years, 10 years. They have given 5 times 5-year loan could be rolled over, so that, over the active life of the project, the loan can be serviced in a more and more feasible way. Upgrade the credit, banks have to upgrade their credit appraisal method so that only economically viable and technically feasible projects go further and get loans. We have to strengthen the supervision of bank supervisions through good regulation, which Reserve Bank has been asking for a really long time. Team up with NGOs, self-help groups to improve loan quality, especially in the rural areas, because that's also one of the big issues which we have now. The next related challenge is profitability in banks. If you look at these numbers, for last 4 years, both return on assets as well as return on equity has been falling. In fact, they were as high as 13.6% in March 11. Now its return on equity has come down to 9.4% in March 15, and return on assets is as low as 0.8%, which is a very thin margin, and I think we need to take several measures like improving operating efficiencies by proper, cost efficiencies, increase non-fund business so that you have more fee income in your portfolio, improved asset utilizations, address structural issues, especially the banks, why public sector banks are not faring as well as private sector and foreign banks are doing. I think that this government, Department of Financial Services, is looking at that aspect for quite some time now. Corporate bond market, if we look at numbers, it has been continuously growing from FY11 to FY12 to FY13, but FY14 was a bad year. We have again come down in FY14, but fortunately FY15 was a very good year for the corporate bond market. But if you look at those two bars, the bars for public offering is very, very small. So the entire market is only private placements, and that too only, if you look at private placement numbers, most of our financial companies' numbers, manufacturing infrastructure are still away from the corporate bond market, and we need to see that corporates, manufacturing, infrastructure companies also start accessing corporate bond market very soon. The issues in corporate bond market, there are a lot of work has been done on this. Dr. R.H. Patel committee report worked on corporate bond market. There's Dr. Rakesh Mohan committee report. What are the infrastructure support is required for the corporate segment is already in place. But if you look at the transaction in the corporate bond market, they're hardly there. There's no secondary market. There's lack of liquidity and depth. Nobody wants to, if there's a liquidity in the market, primary market also get boost because people know they can get out the day they would like to get out of this market. Limited players in the market, only institutional, whether it's a banks, private insurance companies, mutual funds. There are hardly any retail participation there. Higher preference public debt or high rated corporate private paper, but nothing for, a bank can lend. If you look at my portfolio of ratings in bank loans, my median rating would be BBB minus or BB plus. But if you go to corporate debt market, even with the A-rated paper, nobody will buy A paper in, but same bank will go and lend to a BB loan, but will not buy a paper which is A or A plus even in India. That's a problem in your markets. Everywhere there's a more, market for even junk paper, but A or A plus paper, which has better rated papers, nobody would like to touch that kind of paper. We need to have wide array of instruments and products. There are a lot of zero strip bonds, callable bonds, I think capital index bonds. I think we need to introduce many products which we are in those markets. And a big problem, another problem in corporate bond segment is absence of market makers. If you look at GSEC market, they are primary dealers who provide two-way quotes. They are market makers. But in debenture corporate bond segment, there are no market makers. So hardly, if you suppose you have to buy 100,000 shares of a particular company, you can go and tell your broker to buy that. You will get both buy and sell rates. But if you tell him, I want to buy 1,000, let me take a name, 1,000 debenture of Reliance Industries, which is one of the best company in India, you can't buy, you don't know where to go and buy those 1,000 debentures. So that's a problem in corporate debt segment. Development of market infrastructure. In fact, there's a good progress on this. Both SEBI and RBI has taken a lot of steps to improve the market infrastructure, but we need players to come in and start transacting. And next, ease of transacting, we want to bring the cost down so that there's a, people start trading on the capital markets on corporate bonds. What has been done so far? There's a FIMDA, unfortunately spelling is wrong, FIMDA platform has been developed, and I think it has platform has made it more transparent. The FI limits for investment in corporate bonds and raised from $15 billion to $20 billion. Banks have been allowed to invest in unrated bonds of infrastructure within their overall limit of 10%. Provisioning norms for infrastructure loan accounts have been relaxed recently by Reserve Bank of India because this sector faced a lot of pressures because of some decisions taken by the previous government. Banks have issued detailed guidance on setting of IDFs now. The repo in corporate bonds permitted under comprehensive regulated framework. All these steps have been taken to help the corporate bond segment. But there are many things which need to be done to help corporate bond segment develop. We need more players. And if you look at total financial savings and look at what are the saving in the financial instruments, there's a big gap. So money is going still to gold, money is going to real estate, money is being kept as cash with public. I think it needs to come in the market. Secondary market is more buoyant, and we have always seen when secondary markets are good, there's a lot of interest in the primary market of corporate bonds. Need to promote administrative ease, increase market development and making to make it more transparent. Need to consider the system of bank lending. In fact, there's a paper which is circulated by RBI, for discussion, which says that large projects, a part of the project should also be funded through corporate debt segment. It's not necessary that 100% of the project has to be financed through a bank loan. Some part should come out of the, especially the large ones, some part should be contributed to the corporate board segment. Establish a regulatory framework. We know it, there are very, very competent and effective regulators, but there's a problem here. RBI controls banks, SEBI controls capital markets, PFRDA controls provident funds, insurance, IRDA regulates insurance. They need to coordinate between each other because all these players have a very cemented role in the corporate debt segment. Provision for credit enhancements, especially infrastructure funds, which has, fortunately, RBI has allowed banks to give bank guarantees, partial bank guarantees to